Fellow investors, welcome to Fundamental Analysis. My name is Varun Kapoor and I appreciate you watching this channel. Up today, I want you to discuss one of the most famous names in the consumer goods sector. It's called Unilever, and I want you to do qualitative and quantitative analysis to see what kind of return a long-term investor may be able to achieve. So let's dig in. What does Unilever do? We're not going to spend too much time on it because I'm pretty sure that most of you have used their products or are aware of the brands that they have. But just to summarize it very quickly, it's got about 2.5 billion people use its product every day. Some of their products are some of the most well-known products in the world. 58% of their revenue comes from emerging markets, but it's got operations and distribution across the globe. It's got 25 million retail outlets in their distribution chain, and they've got 13 brands in their portfolio, which are above 1 billion. So clearly a lot of powerful brand names in there. I would mention the company's market cap is roughly about 100 billion sterling as of today, and company has roughly about 2.25 turns of leverage. The company's EBITDA for the last 3-4 years has been around 10 billion. So such a great name. You would normally expect that with global economy growing, the demand for fast-moving consumer goods has been growing, and that should benefit a name like Unilever. So let's look at their share price to see how their share price has done over the last 4 years. So here is the share price analysis for Unilever. As you can probably see here, this is about 2017. This is around the same time when Kraft Heinz made a bid for Unilever for about roughly around 140 billion US dollars. So that's in US dollars. But at that point of time, the company's share price was around 45 pounds. And if you see where the share price is 4 years down the line, the share price is, as of today, is 38 pounds 79 pence. So really for the last 4 years, the share price has not gone anywhere, which is not great, because if you look at the competitors like Nestle and P&G, their share price has done much better. So let's see why the share price for Unilever has not performed that well in the last 4 years. So this is a very simple table, and this table has directly been taken from the annual report of Unilever, and I would urge all of you to look at the annual report to dig into some of these numbers. But this is essentially a table that explains the real issues that Unilever is facing right now. So Unilever has got 3 divisions. You can see here, one is called beauty and personal care, the other one is called foods and refreshment, and the third one is called home care. So if you look at their revenues over the last 3 years, and this goes in this particular order. So 2018 it was 20.6 billion, and at the end of 2020 it was 21.1 billion. So really not much growth that you can see here. Foods and refreshment has actually gone backwards. So that's 20.2 billion in 2018, has reduced to 19.1 billion as at the end of December 2020. And home care division has gone from 10.1 billion to 10.5 billion. So 3 main divisions, none of those divisions have shown any growth. Now, admittedly, they have sold some of their businesses, but at the same time, we need to keep in mind that they have bought some businesses. So for a name like this, which is making lots of acquisitions and at the same time, making disposals, you would expect that the strategy of the management should be working such that their revenue should be going up over a few years. But that is not to be seen here, and that really is a problem whereby company strategy is under question. So let's quickly analyze the financial analysis performance of Unilever to see not only how it has done from a revenue perspective, but how that revenue has converted into profitability. And EBITDA is the metric that we use to understand profitability of corporates like these. And then finally, we will also look at how the company has been able to convert that EBITDA into cash flow generation. So if you look at the revenue here for Unilever, you will see that over the last 5 years, it hasn't really gone anywhere. It was 52 billion in 2016, and as of the latest information that is available to us, the company's revenue number is about 51 billion. So that's the first issue. The revenue is not really growing. If you look at the EBITDA for the business, it's essentially gone from 9.2 billion in 2016 and then increased to about 10.4 billion in 2017. We will ignore this number because this includes some one-off items that the company benefited from. But the real worry for investors like us is if you look at what happened in 2019, 2020 and the latest period here, your EBITDA has essentially gone backwards. So again, companies' management strategy is under question here. If you look at the EBITDA margin, how much margin they're making, it's essentially gone from 17.6% and then it increased to 20.6%, but then it's gone backwards again. So again, from a profitability perspective and an absolute amount of pounds and dollars that the company is making, it doesn't look a very pretty picture. So that's the profitability aspect. If you look at the free cash flow available for equity, because ultimately as value investors, we all focus on how much cash the company is generating. Again, I would say it is not a very positive picture. So you look at 4.2 billion here. We have to ignore these two columns because this is around the time when Kraft Heinz was making an offer for this company, and company was scrambling to pay out more and more amount to its shareholders in form of share buyback and dividends, such that the company was essentially selling assets or raising debt to pay those amounts. So these amounts we need to ignore. And then when Kraft Heinz offer went away, we are back to a situation where we are at 5.5 billion, 5.4 billion, and then this is really worrying because the last 12 months number for the period ended June 2021 is about 4.3 billion, and that is not really a very positive trajectory. And I think that kind of summarizes the real issues that Unilever is facing. There is no top line growth. There is no revenue growth that we have seen in the last 4 years. There is EBITDA has been, you can call it, under pressure in the last couple of years as well. As we talked about, it's gone from 10.5 billion to about 10 billion in the latest period, and then free cash flow available for equity holders, as I said, is also under pressure. And that kind of summarizes the real concerns that investors like us have, where we haven't really seen any growth. Whereas if you look at its competitors, as I mentioned, Nestle and P&G, they have shown much better performance over the last couple of years. So just very quickly on some valuation metrics, you can see here free cash flow yield, which is free cash flow available for equity holders divided by its market cap. It's gone from about 3.8%, and as I said, these two numbers are artificially inflated. It's gone from 3.8% to 4%, and then now it's down to 3.5%. Enterprise value to EBITDA, which is another valuation metric that we look at, it's been 13.5 times to call it 14 times is generally where the valuation has been. As a lot of you will know, the equity market valuations generally have been quite robust in the market, but it's quite interesting to know that the valuation for Unilever has kept steady at around 13.5 to 14 times. Now this is the other worry. If you will see leverage, which is net debt to EBITDA, it's gone from 1.4 times to 2.3 times. And in the last couple of years, it's shown a consistent increase. And the company is doing that because it's taking on more and more debt so that it can keep paying its dividends. So let's see how we can project out this name 5 years forward. Here you can see over the last 5.5 years, the average revenue growth has been negative 0.8%. I have assumed that going forward, the next 5 years, the company is going to grow at 2%. The reason for giving them benefit is that company has been selling its low margin and low growth businesses and trying to acquire and go into areas that are more profitable and faster growing. And I have given them the benefit of doubt and assumed that the company is able to deliver on those changes, and hence the revenue grows at 2%. EBITDA margin, last 5 years average is 19.5%, and I have again assumed that the company's strategy does work out and EBITDA margin does increase because of venturing into new higher profitable areas, and hence the margin increases to 20.5%. Free cash flow available to equity holders as a percentage of EBITDA has been 48.2% over the last 5 years. Here I have assumed 47%. The reason for giving them slight penalty is that the company's capex has been going down, and I suspect there may be some catch-up capex coming down the line, and hence I've given them a slightly lower number than 48.2%. So what valuation do we get in 5 years' time then? 5.5-year average free cash flow available to equity holders yield of 3.9%. Remember, this excludes the 2 years that we talked about, which were artificially inflated at the time of the Kraft Heinz discussions. And if you assume that the free cash flow yield stays at 3.9%, then based on the free cash flow assumptions that we have made, company's market cap in 5 years' time is 139 billion euros. On an enterprise value to EBITDA basis, we have assumed company's valuation is roughly 14 times, which is what the valuation has been in the last 5 years. And that gives you a market cap in 5 years' time of 138 billion. So we have two methodologies. Free cash flow yield gives us 139 billion. Enterprise value to EBITDA gives us a market cap of 138.7 billion. And to come up with a view in 5 years' time, we have basically split the difference and assumed that the market cap in 5 years' time is going to be 139 billion euros. So this is the IRR analysis here. This is the current market capitalization. This is in euros, so it's 119 billion euros is the entry price. And these are the cash flows that we expect the company to be generating over the next 5 years. And exit valuation, as you can see here, is 139 billion euros, which is essentially the same that we just calculated. And that gives us an IRR of 6.9%. And that is quite a weak IRR because at least my investment portfolio, I look to invest in companies that provide me 10%, minimum 10% IRR. And although I am a holder of this name, I have not been adding anything. And because of the dynamics that we have seen, we have talked about of lack of revenue growth, this is one of those investments which has unfortunately not worked out for me yet. So I'm not selling it out because I don't think that this is an investment where you're going to be losing a lot of money, but this is going to be substandard IRR. At this point of time, I am in this name for potential upside. If the management can deliver some acquisitions, some growth, some organic growth in the business, then we can see that this 6.9% may go up. But as things stand today, the company has struggled to generate organic growth, and my base case therefore assumes the IRR is 6.9%. So that's Unilever. I think we have discussed the issues that the company is facing, lack of organic growth, the profit margins, the EBITDA margins haven't increased, the free cash flow is under pressure, and the market cap hasn't really gone anywhere. And even giving company some benefit of doubt and giving them organic growth assumptions of 2% that we talked about, I still only get an IRR of 6.9%, which is substandard, and therefore I am not adding this name at the current levels. So that was Unilever. If you have any questions, then please reach out to me via this channel, and I'll make sure that I answer those questions. Till we talk next time, thank you for watching. Bye now.